Welcome everyone to another edition of the Roundtable Discussion. This format has been extremely beneficial for us at Finlearn, and as we sort of extended it across other, with other influencers as well. So, welcome once again to this one. Today's discussion is on the insurance industry and the LIC IPO. So, just a brief background on our panelists. So Saurabh has founded Scientific Investing, is very, very active on Twitter in helping and educating retail traders and investors on finding a very thought-oriented and a process-driven approach to trading and investing. Piyush Chitlangia is the founder of FinShiksha, which is actually also following a very, very similar approach, but for a target market that is say for users who are in graduate school or in postgraduate school and are getting ready for their first job or for their first job in finance. So something that's common across both of these individuals is, and something that's common across all three of us is a very single-minded approach to not do any tips and recommendations. We believe education is important. We believe in teaching, and we believe in education, and that's what the entire objective of these roundtable discussions is. It is not particularly to share any recommendations, it's but to sort of share knowledge, so much so that you as a trader, investor can choose your own processes to invest and trade in a very risk-averse manner. Yeah, so without further ado, let's talk about what we're going to discuss today in this particular session. Like the slide says, insurance industry is unnecessarily complicated. But that being said, it is actually one industry that if you sort of gather some key terms, if you sort of understand what are the key methodologies, data gets released every month. So for you to track as on a month-on-month basis, it becomes a lot easier. You don't particularly need to wait for quarterly numbers to sort of analyze the space. It is a very if you demystify it, if you go through the jargons, then the process is quite straightforward, right? Because ultimately, what is insurance? It's something that is helping us to protect ourselves. So at the core of it, it's quite simple. There are a fair few listed players now as well, and with the LIC IPO coming through, there are options for you, right? Now, ultimately, India is, when I compare it to at a global level, has a massive protection gap. Now, we are not under-penetrated, but we are under-insured. And that ultimately gives us a multi-year growth story ahead. Like, if we are able to play this growth, then you have a runway for the next 10, 15 years in terms of actually sort of capitalizing and insuring, so to say. So now LIC, right? Like now LIC's Sanskrit tagline, and this is really interesting. I was doing my research and I found out that LIC's Sanskrit tagline is actually taken from the Holy Gita, and it says, "I carry the responsibility of your well-being." That tells us a lot about how and why and how this company has been formed. It's the oldest insurer. It had a 20+ year runway on other insurers before the industry opened up to private players. It is estimated that approximately 10 out of 100 rupees that an Indian household saves actually is goes to LIC. And that sort of tells you the mammoth scale at which this particular company runs. It has approximately 520 billion USD in assets under management, of which close to 29% is in domestic equities. So you can imagine the kind of scale that we're talking about. From a business perspective, LIC has approximately 40% market share, albeit decreasing, and we will discuss this in the presentation, focusing primarily on a savings mix product and a heavy agent-driven model. There are pros and cons to this as well, which is what we'll look at. But before we sort of get into LIC, let's sort of look at what the insurance industry is all about. What are some key terms you should track? Which are the key players? How do you value these companies? And then we'll compare LIC to the different players that we have and arrive at a I think across the three of us, we have a consensus on what we make of if one should sort of subscribe to the IPO or not. But that's for you to sort of decide with all the information that we end up sharing over here. So yes, let's get started. The first slide is sorry, yeah. So Piyush, why don't you take us through some of the key salient features of the industry at large?
Sure. Thanks, Ronak, for the warm welcome. Glad to be here with you and Saurabh. Privileged to be talking to so many people today. And just before I start, a quick check. My voice is reaching clear to everyone? Yeah, great. So, this is a very interesting industry, and an industry which sort of cannot be evaluated very easily using conventional metrics. So let's talk about the first context of who are the key players and how does that play. So this industry structure in India is kind of an oligopoly, which will have a few large players and then a lot of small players. Once the industry got opened up, then there are now about, I think, if I'm not wrong, 24, 25 odd players. The top 5 kind of control nearly 85% of the market share in terms of the premiums that are collected on an annual basis. As a product, insurance is a slightly tricky product because it's not something that comes intuitively to us. It's like risk management. So we, you have to go and talk to somebody and tell them that, look, there's a risk to your life. And so you want to kind of take care of that risk management because, after something were to happen to someone, then, how does the family cope up with the rest of it? There's a slightly tricky discussion in the first place. So inherently it's a push product, right? People don't want to think about their own sort of end, right, in that context. So that's where the challenge of this sort of kind of comes in, which is where inherently a channel that is available to kind of sell this product is useful. So banks tend to do well because they have a huge distribution network that is available. And as we know, in the case of LIC, they have been able to sort of establish this trust using all their agents. The agent would be probably a person or a family member or someone who's close to you. And in that context, that social circle and the entire trust-based sort of product positioning kind of comes into the picture. That obviously puts the advantage with some of the key top players with respect to whether you have an access to a bank or whether you have a good agent network that is available. Banks also have additional advantages in terms of, there's a large customer base. There's a lot of data that is collected these days. So, who's earning what kind of savings products they are looking at, what kind of investing products they are looking at. And they could try and use this in some form or fashion of cross-selling. Plus the distribution network anyway exists. It's a very long gestation and duration product, right? Unlike some of the other products where you're looking at things after 1 year, 2 year, 3 year, insurance is usually 10 years, 15 years, 20 years, right? That is good and bad. Good because from the insurance industry perspective, obviously you're not really looking at, if it is an investment product under insurance, you're not really looking at returns day to day because it's a 20-year product and you're locked in through the structure or whatever, that reduces the pressure on the sort of the investment managers in this segment to kind of have a return methodology coming to the picture in terms of focusing too much on short-term returns is not really required in this case. The negative is you can't evaluate too many products because the timeline is so large that our mind doesn't understand what is the difference between a 7% CAGR and 7.5% CAGR over a 20-year period. Right. So products that are not so good also get away with that kind of a return generation, assuming there's a return generation in the first place. Primarily in India, most of it is sold as a mix of savings, tax savings, and risk cover products. I have a running joke, which is, in the months we are in, which is February and March, this is the time suddenly all health insurance and life insurance companies suddenly become sort of too concerned about our life, our health, and and this primarily it's being sold as some sort of a health as a tax saving product. And because March end is coming, they'll try and push this around this time. Acha, apne, if you've not done the ELSS at this point of time, to insurance mein paisa dal dijiye. And all the. There's another intriguing thing about this, that historically this has been a slightly opaque industry. It's I think Saurabh will cover a little bit of that with respect to how IRDA sort of manages it. But this is an industry which there's a common saying that on actual mathematical return terms, if you're buying an investment product through an insurance channel, it's never going to stand the scrutiny against, let's say, a mutual fund or something. Usually you'll find that a mutual fund is better than insurance. There are other angles that come into it, behavioral, discipline wise. Can you continue sort of investing for 20 years? Otherwise, if you're a mutual fund or a stock investor, every day you look at the market movement and you start thinking, acha, aaj kya karna hai? Right? Abhi, what's happening with Russia, Ukraine? Insurance doesn't give you that option, right? Discipline is sort of self-instilled and installed in that entire equation, which sometimes is useful for most retail investors as such. But yeah, you can't really get away from the fact that a lot of the insurance industry uses emotional angles to sort of push this product, because otherwise it's a difficult product for people to directly go and buy on their own. Right. Having said that, globally, there's a lot of interesting growth opportunity that has been seen across the geographies. And so we are at a cusp of sort of a high growth phase in this kind of an industry. We'll see a lot more interesting action. There are some key terms that come here, and I'll let the terms discussion probably sort of could outline them a little bit more. Just before we go there, think of this as if you look at a manufacturing company, right? If you're producing something, let's say you're producing a mobile phone, the cost of that phone and the marketing of that phone is sort of immediately expensed out. And the benefit you're going to get out of that, selling that phone and manufacturing and selling that phone is also sort of immediately achievable, because you have sold the phone, you'll get the money. So from an accounting perspective, the simple conventional accounting works well, that, in the P&L, you'll see sales, you'll see costs, you'll see marketing costs, and you'll get to the final profit number after paying taxes and all. And that works. Insurance spends upfront. You will have to spend on advertising. You'll have to spend on getting the customer. You'll have to spend on the channel. If there's a distributor, you have to pay commission to the distributor. All these costs are loaded upfront, and under accounting principles, you can't really sort of, use these costs and capitalize them over the life of the product. The product is going to basically come and give you profits only after a few years, because the first few years it doesn't do anything. So if you look at conventional methodology of looking at profits today, or looking at PE ratios, or looking at any kind of thing that relies on earnings today, this is an industry that will be, you'll penalize it unnecessarily just because it's a long-term product. So conventional methodology doesn't apply in this. We will use some terms like embedded value, value of new business, what is annual premium equivalent, persistency ratio. Some of these key terms will keep coming across our discussion. But yeah, that's my take on the industry as we speak. And if Saurav would want to add something to this, he could go ahead now.
Sure. Thanks, Piyush, and thanks, Ronak, for the introduction. I think this is the second time. I hope I'm audible.
Yes.
Am I audible?
Yeah.
Yes.
Okay. Yeah. So first, thanks, Ronak. I think this is the second presentation we are doing, and the last one which we did was on the IPOs. I think we did right in November or December when IPO mania was at peak, and I think now when I look, 3 months back, looks like that discussion was worthwhile. Seeing what has happened to IPO and what we discussed. So I hope even the current discussion which we are having along with you and Piyush, I hope it is going to be fruitful, insightful, and glad to share the dice with Piyush. Though we are at a forum for the first time, it has been really great to work together in last 2-3 weeks and sink in together. So thanks, Piyush. So Piyush beautifully explained about the context of the industry. A few more things which I would like to add. So one, whatever we are going to discuss today, this will be more in context with life insurance. So insurance in general, you have general insurance, you have life insurance, you have reinsurance, and all of them are little different. The business model, everything is very, very different. So we will focus more on life insurance, where Piyush told it's a long tail one, because if you'll go with the health insurance, the normal tenure is 1 or 2 years, but life insurance, usually the tenure is much, much, much higher. One more point which Piyush highlighted, and I would like to stress upon, is the under penetration versus under insured debate. And why it is important, because many times when you'll see a lot of reports pushing some of the companies, the picture is shown as a very rosy picture, and you'll see this number like 3.1%, which will, visually, mentally, you'll see, only 3% under penetrated. So there is so much of scope to grow. But there is a difference between, and that number is not a great number. If you'll see, US is also somewhere around the same number, being a developed nation. But where India lacks is more under insured, because the key purpose of insurance is to insure the people for their lives, but somehow the way insurance, as Piyush said, it's a push product. It has become a saving product. There are ATC tax benefits. So insurance is being sold a lot as a saving product. And that is why if you will see the penetration, whatever data you look at the data in terms of, I think Ronak gave the data, 10% of household saving is going into insurance. So that's not a bad amount. Even if you look from different angles, you will try to see how the household saving is going, where the insurance is, what kind of asset insurance industry comprise of the total debt portfolio of the country, the total equity portfolio of the industry. It's not under penetrated. Yes, it is growing. It is growing because India is growing, the GDP is growing, the saving is growing, and hence it is growing. But don't rely a lot on that 3% number. That way, I think there is a tremendous scope of selling insurance as an insurance, and that way, yes, we are insured, but we may not be under penetrated. Second thing is it's an industry which is heavily regulated. It is regulated by IRDA, and a lot of things, a lot of policies which come, they are driven by IRDA. So the industry has a history of many times going through certain major changes driven by IRDA. If you look at the insurance history of India itself of last 20-30 years, it has gone into 3-4 phases. Where first it went undergone privatization, and then the private players came up with new kind of products. Some of the products which were not so customer friendly, the regulator came heavily with them. Then the industry went through a lean phase. Then again, the players, they realigned themselves. Again, the products were made customer friendly. Again, it went through new phase of growth. So regulator has a very, very strong role to play. Even if we look on the general insurance side, how much margins or how much bonus can the agents make, what is the maximum pricing you can have. So regulator has lots and lots of say in lot of these things, and as an investor we have to be cautious, because one new regulation, the kind of change it can make to investment decisions, I think we should not discard it. Like, I'm just sending a hypothetical scenario. What if tomorrow in some of the policies this ATC tax benefit goes off? So many people may not like to go for that. So we have to be cognizant of the role regulator plays. Third, even if we are talking about life insurance, there are different kinds of business models, and there is different way to evaluate compared to other industry. So what is the distribution channel? Is it agent based, or is it bank insurance driven? Is it direct? What kind of products are there? And we will discuss all of this in detail as we go. But there are different ways the products are there, whether it's participating, and we'll tell you how to evaluate all of this. What is the pros, what is the cons? But you have participating versus non-participating, linked versus non-linked, single versus group. So lot of differentiation. And when you start analyzing each of these listed players, whether it is HDFC or it is ICICI or the upcoming LIC, you will see all of these companies, the differences will start emerging. And the key lies in how do you differentiate these companies? How do you understand the uniqueness of these companies, and then look at these companies from quality and valuation angle, and then tag a valuation, rather than telling ki insurance company hai, so they should get 2 embedded value or 3 embedded value. So we'll slowly try to uncover all these things as we go ahead. So again, passing to you, Ronak. I think I covered what additional I had to say on the industry.
There's one question here, Saurabh. You mentioned a really interesting point on regulator playing a very important role. Right? Of course, like in India, we're pretty used to being heavily regulated across most industries, right? Any examples that you can think of that in the past, how IRD has sort of done willy-nilly changed regulations, or something that we as investors, we should be cognizant of, that, this is something that happened in the past?
Yeah, so 2 examples I can tell, one which has already happened and 1 or 2 which may happen. So if you look at a lot of like general insurance products, the pricing was defined, and then they were de-tariffed. So players, they had their own choice to decide the pricing, which usually leads to a price war. And then first few years, there is a lot of competition, then the market settles. And one by one, slowly the products were de-tariffed. Still, there is one auto product which is not de-tariffed. So the moment it is de-tariffed, and it will may happen in the next 3 to 5 years. So the players who are heavy on those kind of products, they might feel pricing pressure. The other thing in terms of currently what is going on is the regulator is mulling over whether the life insurance company should be allowed to sell health insurance policies. So if you look at the developed nation, actually there are countries where life insurance companies, they do sell health insurance policies. So if that kind of regulation comes, it will change the industry dynamics a little bit. The life insurance companies may be at an advantage. The health insurance, pure play health insurance player may be affected a lot. So these are the kind of regulation changes which the regulator comes at times and which can have the impact on the companies from investing perspective.
Cool. Thank you so much for that, sir. Yeah. So Piyush, do you want to spend a couple of minutes on just sort of, so Saurabh mentioned on the different products, linked, non-linked, ULIPs. We've all heard these names. Piyush, you just want to debunk the different types of it, like you can take some and Saurabh can take some, like we can figure it out.
Sure. So I'll probably just briefly outline it in terms of, what are the various types of products. When you think of insurance, just think of it as either a pure insurance, which is a pure protection, or something that also gives, your savings and investments back to you in some form or fashion. Now, of course, it's a, complex industry. So there are combinations of these that have started coming up as a product as well. We have heard of something called as term return of premium policies that have come in, but just think about it as a simple pure play insurance जैसा हम अपने vehicle के लिए रहते हैं, right? If we just buy a vehicle insurance, the premium is paid and we don't get anything back, right? God forbid if there's some challenge in terms of some accident, then basically the insurance protection actually comes into the picture. Otherwise, technically that money is gone. So that's the pure protection mechanism where the payout is contingent to the actual underlying risk materializing, right? Be it health, be it term, be it auto, whatever the case be. So pure protection plans are called term plans. These are relatively dirt cheap when you think of it from the investor's perspective, but they've only taken off in the recent past in India. They haven't taken off earlier purely because they are not very, you don't have to pay too much margin. I mean, if a 30-year-old has to take a 1 crore cover, the person might be probably paying somewhere to the tune of, 8 to 10,000 as annual premium for a 15 to 20-year product. So this is relatively inexpensive, but it's a pure cover. You don't get your money back, right? In the other end is the set of products which include sort of club the savings and investment angle with it, where you are paying a premium. The premium is a combination of what you would have paid purely for the protection plus some money that is going to get invested on your behalf. And at the end of the period, or in the case of the risk materializing, you will get the sort of sum assured plus, if there's any investment returns that you've made, those also will start sort of coming out to you. So it becomes sort of a saving plus protection kind of a product. Usually, most of the cases, these products can get divided further into sort of something that is linked and something that is non-linked. Linked products are linked to an underlying market, right? So usually you will see the ULIPs or unit linked insurance plans, which is nothing but products that will invest on your behalf like a mutual fund into stocks, for example, or bonds, for example, right? Sorry. So this, because it's unit linked, the returns are dependent on what's happening with the underlying instrument, and that becomes sort of the linked products. Then there are non-linked products, which are also called as traditional products. Within that, there are sort of two categories: participating and non-participating. These are typically sort of products that will give you a safe, low, return, but a standard sort of thing. There's no risk, sort of less risk that is taken as compared to a unit linked product, which might be investing in equity markets. Something goes wrong, you lose money there. That is a possibility. In non-linked, that risk doesn't come. It's mostly debt kind of an instrument that is going to come under. Within that, there's this breakup of participating and non-participating. In participating, if the insurance company makes some returns, they will share a part of that with the policyholders. In non-participating, your payout is sort of kind of predefined. You'll get a certain amount of money based on how the underlying performs. There's no real participation of additional profits that the insurance firm could make out of this, right? So that's in a nutshell the breakup of how the industry is kind of positioned. Saurabh can probably add a little bit more with respect to which of these products has a higher margin and how the industry in India is structured around this.
So you want to take up?
Yeah, sure. Thanks, Piyush. So why the understanding of these products? Yeah. So the reason why understanding of these products is required because from an investing perspective, how a company's or insurance company's portfolio is distributed across these products. That has a lot to do with what kind of profit that insurance company will make, what kind of VNB margin this company will make, what kind of risks this company will carry. So let me take an example. Let's say if we are talking about participating versus non-participating product. So basically in a participating product, the customers of the insurance, they also participate in the returns, and whether they're investing in equity or debt, they also participate and get a share of profit in the form of annual bonus and all. The risk or the return, basically it is shared, versus a non-participating product where the insurer will come and he will tell, okay, I will give you this much. So the insurer has to be very accurate in his product calculations. What is the kind of mortality rate he's expecting, what is the kind of interest rate he's expecting. And imagine if it goes through a wrong cycle. And actually historically, if you look at globally, even in the last 6-7 decades, many companies blew up. Many times they couldn't take the right assumption on these variables, and when they went through a recession or those kind of scenarios, it led to negative circumstances. So of course the industry is much more learned right now, but this is the kind of risk one carries. And even if you look in terms of VNB margin, like if you look at a ULIP will have kind of lowest VNB margin versus a term insurance product which will have a highest VNB margin. So don't look just that, okay, this company is selling so much of premium, so this is the kind of profit. Many times we get into we will do a relative valuation comparison in the simplest metric, like if they are selling so much of insurance, they should make so much of profit. But lot will depend on all this distribution, and the VNB margins can go up down by 5 to 6x. Like the ULIP margins will be very low, your term insurance margin will be maybe 20 times higher, because it may work on a 40-50% plus margin, whereas ULIPs may work on 2 to 5% kind of margin. Your participating, non-participating may lie somewhere in between. So when you do your valuation exercise, I mean, think all this VNB, embedded value, these are complicated. I also don't understand a lot, but the way you do any kind of DCF or book value calculation, these are similar kind of calculation, where what happens is they try to take the current book and they try to evaluate all the future which will come from the current book, because these premiums will be there for next 8, 10, 15 years. So there's a present value of all the future profit for the current premium book, which is your embedded value. Then comes your new business which the companies are acquiring, and what is the annualized profit coming. So a 20% means if you're writing 100 rupee of new premium, 20 rupees the profit. So it's a combination. So when you're doing this valuation exercise, this product distribution and the kind of VNB margin each of the products garner, that becomes very, very important. And hence it is important to understand all these concepts, look at all this data, and then do the exercise of what kind of risk a company carries. Like imagine if a company has 80% of the premiums in non-participating, then the kind of balance sheet risk which they are having is very, very high, versus a ULIP product where there is no balance sheet risk. ULIP is like asset under management. You are investing that money, the premium, and then you are sharing it with the with your subscribers of the policies. So it's very, very different, and one need to highlight and differentiate all these things.
Yeah. We will get into how each insurer, life insurer, has skewed towards which particular product in the ensuing slides. So what will then make sense in the process is everything Saurabh has said in terms of growth as well as in terms of margins, and how these products sort of have performed with respect to these insurers, and what has been sort of the history with these insurers. So LIC, how have they performed in terms of these products, and what are they, say, pivoting towards, and what have other companies, how did they start off and how have they pivoted towards these products? So yeah, let's move on. So these are individual versus group, participating, non-participating. So I think we've covered all of these points. So do you just want to sort of touch base on term versus annuity ones?
Yeah. So basically, if you look at a term policy, I think in term policy, you don't get anything back. So it's I would call it the most purest form of insurance, because the whole purpose is to insure. And the difference between term and annuities, term is like all after you die, and annuity is like till you are alive. So in term, let's say if you die then, and you have a term policy of 1 crore rupees where you are paying, let's say a premium of 25,000 per year. So you get that 1 crore in case your death happens. Versus annuity is a product where, there is a kind of fixed annuity income you can earn till you are alive. So it's more around a saving, but still, the concept is still protection, but the difference lies between, when you are getting paid in a term versus annuity. Piyush, would you like to add something more here?
I think this is fine. Just one point I think we missed somewhere in between was this individual versus group thing, which is there. Group is typically, where a corporate is basically sort of giving life insurance to all the employees. So sometimes in employee contracts, there's life insurance cover that is included. And correct me if I'm wrong, Saurabh, individual products will have higher margin than group products for the insurance company, right?
Yes, I think group has almost the least margins
Because it's
of
on a
the
bulk
bargaining power.
and
Because
bargaining
mostly
power
this
of the
is,
corporate. Yeah.
Yeah, this is through the employers. And I think there is one more point. I think one of our audience, Pramesh, highlighted on the expense part, which I think we missed. So yeah, it is very unique about this industry where, your expenses are front loaded. When there's an insurance premium being distributed, there's a cost of acquiring that customer and all of that. All that is expensed in the beginning. So that is very unique about this industry, and that is why this is one industry where you cannot take that P&L like you analyze a IT company or a manufacturing company or a FMCG company. The way you can take a P there, you can't take the same P, because I'm telling the expense part of the P&L is for all the years, where the revenue part, if I say, that is only for the year when you are getting the premium. So that's again a unique thing about the industry. Thanks for highlighting, Pramesh.
Yes. So these are some very specific terms that we have used, and yes. So do you want to? Yeah. So Saurabh, do you want to go through individually what these mean, and then in one of the ensuing slides we can then with Piyush go through how to put these together to sort of value insurance firms before we move into competition and LIC. So do you want to go through these terms?
Yeah. So Piyush, do you want to take, or shall I go ahead?
Anything is fine. I think you can explain the terms and then I can go the valuation thing.
Yeah. So if you look, basically your embedded value is you can say it's the net present value of all the future profits, which is coming from your current book. So let's say there is an insurance company which is there in the market from last 10 years, and they would have sold their policies, which may have premiums to be paid for next 20, 30 years. So your 10th year, 9th year, 8th year, 7th year, consider all of that. That is a part of current book. And there will be a profit which will come in future years out of that book, because people will keep paying their premiums. So embedded value, think it is as a total profit of all those premiums which will come. Versus your VNB and APE. So VNB is something which is for the new business. So one, you already have a book, and this book is going to generate profit for you. Whereas you will be acquiring new customers in the current year, in the next 1 year, next 2 year, next 3 year, and that book is also going to give you profit. So when you think in terms of valuation, your final valuation of any company will be the total profit you make, and then you would like to give it a multiple. Maybe let's say if you take a normal IT industry, you'll say, okay, if this company is making 100 rupee profit, I will give a 20x valuation. So in the insurance, when you say the total profit company is going to make, there are two parts. The first part is profit being made from the current set of policy holders, and the second part is profit to be made from new set of policy holders which you will acquire. So I'm just trying to simplify in a very, very basic manner. So the valuation which is coming from the current set of policy holder current book, that is your embedded value, and then the profit pool which can come from the new set of customers, that will be the VNB. So I'm explaining VNB again. Let us say if you are getting 100 rupee of new premium, and let us say, I see a lot of this is all accounting. All of this is actuary and accounting. So don't think this as a actual profit. The actual profit may be a different one, but based on that actuary, the number comes. So if you are writing 100 rupee of new annual premium, and if there is 20 rupee of profit you are making, that becomes your 20% or 25 rupee, 25% VNB margin. So when you will try to value a business, you will give a valuation multiple. So there are two ways to valuating. One is companies can have an embedded value, and you'll see one valuation where they will say that because India is a high growth nation, India should deserve 3 times embedded value. Versus a developed nation, they are not growing, they are growing at 1-2%. So they say that they should get only 1 time embedded value. The other way of valuing is you keep the embedded value separate, because I know this is my current book, so I will not give any multiple. I know this is there and this is the profit, total net present value of profit. But what I will do for the growth, I will take the VNB and then I will give a multiple to my VNB book. So now, depending again on the nature of the country, the nature of growth and all, you can tag. And if based on whatever papers and all I have read, usually this multiple comes somewhere around 10 to 30. So your embedded value plus 10 times your VNB, which is more like an annual profit from new customers. And then for that, you can give a multiple. If you are very conservative, you see the growth rates are low, there is not a very long runway, maybe you can give somewhere around 10. But if you feel, there is a lot of runway, the company can grow and all, you can go to, 25, 30. But when you will try to evaluate Indian companies, you will see there are companies which are below 30 also, and there are companies which are above 30 also. And annual premium equivalent, it is a measure of the comparison of the revenue by normalizing the policy premiums into the equivalent for regular annual payments. So why it is important is, again, because we will be discussing about LIC, and there are a lot of data thrown about LIC being a market leader, and you see it has 80% of the policies written, 70% of the policy premium. So that includes a lot of history, but valuation and investing is all about the future. So the question will be, tell me what is currently it is doing, and tell me whether it will grow at talking in terms of today, annual premium, normalized annual premium, which is being calculated. And you might see that the overall premium share versus the APE share, there could be a difference between what LIC is garnering out of the whole insurance industry, as a total premium versus APE premium and all. So that is where the APE premium comes. So think all these terms as, present policyholder driving valuation, new policyholder driving valuation. In terms of calculation, you can do a direct embedded value multiple, or you can break into embedded value and VNB, and you can take a embedded value plus multiple of VNB, and then you can tag a multiple between 10 to 30, and then you can arrive at the valuation of various companies. Of course, again, you need to look at the product distribution and all of that. But this is how the industry terminologies are, and this is how it is used in the overall valuation and business calculation purposes. So anything you want to add?
Yeah. So thanks. I think this is well explained. I'll just kind of add a few more points, and Ronak, maybe we can go to the valuation slide, so it'll all add together in that context. So think of as Saurabh was saying, think of the insurance company in two parts. One part is that they have the business that is going on right now. So they'll have a certain number of policies that they have created over the past many years till today. And these policies are going to generate a certain amount of money for them over the next many years till the life these policies are there. Now, there's a bunch of assumptions that will go into this, which will be the actuarial assumptions that Saurabh was talking about. So you'll get the premiums from the customers. You will have to probably take out all the commissions that you're paying out. You'll have to take some assumptions in terms of things like what kind of claims will come up, what kind of returns will get generated in the underlying instruments. All those assumptions will eventually give you some sort of a cash flow number. Simple cash flow discounting, just like you do elsewhere, you will discount all these values of the money that you're going to get from all these existing policies. And you'll again take simplistic assumptions. In each insurance company's annual report, you will see the entire embedded value calculation towards the end. Which is then ratified by external agents as well, in terms of that it has been done correctly, and it'll be put up there in the annual report towards the end, so that there's no ambiguity that is involved. All the assumptions, etc., are sort of generally on a conservative basis. They don't go about taking significant return assumptions in that context to just jack up the embedded value. There's no value in doing that essentially, right? So this is your entire existing business, right? Ab existing business mein, there are two components that you can see on the screen. There's the current net worth, which is the profits you've already made. So your total assets minus the external liabilities, you pay out everything. Suppose you shut down the business today, you sell all the assets, you pay all the liabilities. What is left is your net worth, right? Then there is a current business that is going to generate money over the future. You find the present value of all of that. Add these two, that's your embedded value. ठीक है, ये हो गया. Ab you're still doing business. As Saurabh was saying, this is not just history, this future as well, right? So you're generating more policies every year. So you take a certain amount of value for what you're going to generate in the future. Because future is uncertain, what you tend to do is you take the new business in the current year. अच्छा, इस साल हम कितना नया business generate करेंगे, which could be based on premium, which could be based on policies. You'll arrive at a number called value of new business, right? This is the VNB. Is VNB pay, because you are looking at multiple years in the future, you will put a multiple on this, which is like, just like your PE ratio, you will put a multiple on this VNB and say, acha, EV plus 10 times or 15 times, as Saurav was saying, depending on the underlying companies, kya growth parameters and all of that, you'll add that value. And that entire thing, which is history plus future put together, is your total market cap that is going to arrive. So in a sense, it is a back calculation because market cap is available with us. We can remove the embedded value from that. And we know what is the value of new business that is either happened last year or is expected to happen this year. So uspe ek multiple automatically derive ho jayega. Then you can compare whether this multiple makes sense, doesn't make sense, And of course, there are a bunch of assumptions that have gone into it. So it is not necessary that the company will be able to get those profits, as Saurabh was saying. Tomorrow, if interest rates go up, if inflation just spikes up, something goes wrong on the underlying instruments, there could be a problem. This is where what Saurabh was saying makes a lot of relevance in terms of actually understanding the underlying product kya hai. Agar aap ULIP bech rahe hain, if you are selling ULIPs, for example, entire risk is of the investor. Basically, if something goes wrong in the unit-linked products, market goes down 40%, your loss, no problem. The insurance company will just pass on the return that is generated on the product. But if it is a non-participating product, right, and a non-linked, non-participating sort of product where you are saying that, okay, your return is fixed, I have to invest where I have to invest, and something goes wrong there, wahan pe default ho gaya. Eventually, you're buying a bond, right? That bond can default for whatever rhyme or reason. Then there is a huge balance sheet risk that the insurance company is carrying because you have to give that money back. You have sort of given out that I'm going to give 2%, 3%, 5%, whatever return. You have heard of all these products, right? That keep investing, sort of 5,000 rupees a month for the next 15 years. And at the end of 25 years, you're going to get X amount of money, or it'll get compounded. It'll get converted into an annuity. These are products which are sort of defining the exact money. They're not great return products, but for the company, it's a balance sheet risk that is running. And so that you have to keep in mind. There are a couple of questions that have come on, which is, how do
you get these data points?
So data points are all available in the annual reports of these companies. It's a fairly disclosure heavy industry. IRDA comes up with a lot of data on a monthly basis, which is what is a new premium, etc., that is coming in. And each of these companies in their annual reports towards the end will have a huge section. In fact, aap agar LIC ka IPO prospectus dekhenge, the last 50 pages are just VNB and EV discussion on that. कि कैसे embedded value calculate किया है. Then they also give you sort of sensitivity on that embedded value. कि what happens if 1% interest rate goes up? What happens if 1% interest rate goes down? So you have those parameters directly put in your calculations and available in each of these companies' annual report. Of course, there's a little bit of...
Even there are certain forms which they need to fill to... Yeah, there are certain forms which they need to fill to IRDA. So even in that embedded value calculation, all the assumption numbers, what has been used, those forms capture it. And you will see, like I remember when HDFC Insurance came, you could see there were some changes in the numbers. So don't get surprised if, those numbers get changed during IPO price, just to, tweak and tinker with those numbers.
In fact, LIC did something,
it's
right?
Very complicated. Actuarials, they will understand it. Yeah.
Correct. In fact, LIC did something. If you see the FY21 embedded value for them was something like 90,000 crore. And then the way they were sharing the profits, they have multiple pools that were created and they kind of combined those pools. So uske basis pe jo aapka embedded value hai, that went up to something like 5 lakh crore. right? Which is the general way all other companies do it. LIC had a different method of doing it initially, and because they were not listed, they were not supposed to kind of make it comparative. Now they've made it comparative in that context, right? So that's basically what these terms are. One more term that Saurabh had said was this APE thing. इसको समझने के लिए एक और example ले लेते हैं. So we will probably come back to this when we see the market share of LIC. In terms of premiums, life insurance policies, if you think about it, you can either pay the premium every year, or you have mechanisms of paying a single premium as well. In one shot, you pay all the entire premium, right? So if you pay a single premium, which is a upfront premium for the entire policy payment, this will just bloat up your premium collection that year. राइट तो अगर इसके बेसिस पे आप कैलकुलेशन करने लगोगे तो आप जो भी सिंगल प्रीमियम पॉलिसी बेच रहा है that insurer will suddenly become a big market share player, which is what happens with a lot of LIC policies in the first place. What that tends to single premium is also pretty profitable for companies, because then there's no further risk कि आगे पैसा आएगा नहीं आएगा. There's this term called persistency, which is people drop off in these policies after a certain point of time because they see कि अच्छा ठीक है, now we don't need it, or lack of discipline, whatever. So single premium avoids that kind of a situation. Your policy is like paid till the end, and most of what you were supposed to be deriving from it is already derived there. But the premium goes up. So APE जो term होता है उसमें आप first year का premium जो regular premium से उसको you add, and the single premium, correct me if I'm wrong, Saurabh, again here, the single premium thing, you take 10% of that single premium. So if let's say annual premium is 10,000 rupees and somebody has paid 2 lakh rupee single premium, so 10% of 2 lakh plus the annual premiums that have come in will get added to give you the APE number, right? And उस पे कई बार फिर आप you try and find out कि अच्छा उस premium collection पे आपका क्या margin बनेगा based on VNB. You divide the VNB by APE to get your VNB margin basically, which can differ from player to player depending on what kind of products they are selling.
Yep.
Right? Yeah.
Yep. So embedded value, APE, and value of new business. Feel like we have a good base to sort of understand players, because individually these players differ because of the products that they end up selling.
In fact, Ronak, if I can take one example of one listed player itself and explain how it has changed. So like if you take Icici Lombard, FY21, their embedded value was somewhere around 29,000 crore, if I remember. And they made a VNB of around 1,700 crores. What is interesting is if you look at Icici Lombard just 2 years back, their VNB per quarter was around 300 crores. So 300 into 4, around 1,200 crore. And now in FY21, it is around 1,600 crore. Means they have gone from 300 crore to 400 crore and then going up. If you see the premium growth versus the VNB growth, the VNB growth has been much more higher than the premium growth. And when you look at how the product portfolio of ICICI is transformed in last 3-4 years, you will see that 3-4 years back, they were very, very ULIP heavy. And as I said, the VNB margins of the ULIP is very less. And then what HDFC had done, they have tried to do the same. And they have, if you see their share of protection products and term, those share has increased, which means they are getting away from a low VNB margin product to a higher VNB margin product. And this has led to significant lift in your VNB margin. So now, if you think in terms of valuation, FY21 mein embedded value 29,000 crore, let's say it is 30,000 crore. And let us say you can give a range of, because valuation is never a perfect number, it's always a range. So let's say you want to give somewhere between 15 to 20 multiple of the VNB, and VNB FY21 was 1,600, let's say it's 1,800. So 1,800 ka 15 times is around 18,000 and 27,000. So somewhere around 27,000 to 35,000. So your embedded is 30,000 and your VNB multiple comes around 27 to 35,000. So 67,000 to maybe 75,000 could be a fair. I am just giving a very, very rough without doing any detailed analysis, but this is how we do. And if you see ICICI a few months back, it was trading at a price of 700 plus. Now it is trading at a price of 490, and current market cap is 63,000 crore. And at the peak, the market cap was almost around 1 lakh crore. And your actuals might be fluctuating somewhere in between, of course, more. But this is the framework, and this is how you need to do, of course, with a lot of detailing and all.
Back of the end of the PC. Correct. Okay, cool. So with this, to be honest, we finished the industry aspect of it. We've looked at how and why, how the industry is placed in terms of its dynamics, and then we've given a very detailed example of how to sort of value what are the key terms that are used to sort of value these particular companies, right? Let's jump into how firstly LIC, and let's also jump into how sort of LIC places itself against competitors, so you get an understanding of why LIC is where it is, what is the likelihood or what is the path forward for LIC, especially with its products, especially with the fact that it is ultimately a PSU, and how it sort of features in the larger scheme of things. Because with LIC a listing, the insurance industry in a listed space grows manifold, right? And that's a no-brainer. So let's look at how LIC, what are its firstly business dynamics, and then how it sort of compares on a valuation perspective. Piyush, do you want to just sort of let's get started on the premiums?
Sure. So if you look at these comparison, most of these data points are actually available in the IPO prospectus. We've just picked up screenshots from there. So do take a look at these. There's a bunch of pages where this is sort of outlined. If you start with this first table that you see, this is the total premium collection that you see. And, then there's a mix of where is it coming from in terms of individual versus group in the second and third column. So this is total premium, and then there is the new business premium. What is the difference? New business is the new business acquired this year. Total premium is the premium you're also getting for previous policies that are in force at this point of time, right? So agar aap dekhenge, to right at the top, you will see total premium nearly 4,000 billion or 4 trillion, 4 lakh crore के आसपास का आपका total premium collection LIC कर रहा है. And the total the bottom column of that first table is about 6.2 lakh crore is what is totally happening. Private players have about 2.2 lakh crore. So you'll get a sort of a, close to 65-70% market share that LIC has on account of the total premium that is in force at this point of time. In terms of new business premium, their share would be somewhere close to I think 65% के आसपास होगा वो number. One intriguing and thing that you would want to see is on the right side of the lower table, which is in the new business premium. On the customer basis, you will see individual is going down now and group is very high. In fact, LIC has 70% coming from group premium, nearly 30 from individual, and some of the other companies are exactly the opposite. I mean, if you look at something like Max Life, that's like 90% individual, right? If you look at SBI Life, if you look at HDFC, ICICI, all of these are 50 to 60% individual. We already know group has lower margins, so that premium number in itself may not have a very strong bearing in terms of what is the data that is there. It's important to also consider कि वो आ कहाँ से रहा है premium, who's paying that premium, right? So that's one of the things that becomes evident on this slide, that even though the premium is large, a lot of it is coming from group. It is not necessarily coming from individuals. Having said that, it is still a very large number in the context of the size of the industry that is there, right? If you can quickly go to the next slide. I'll just skim through these numbers once, and then Saurabh can also just go through all of these if additional points are to be added there, right? If you look at growth in premiums, right, and you compare the growth in premiums, you'll again note the same thing, that between FY19 and FY21, and if you go back even a few more years and take a decade-long sort of growth in premium, which is FY11 to FY21, you'll see that LIC's total premium and new business premium are both growing at lower rates than some of the top private players. I mean, your SBI Life and HDFC Life are growing at significantly faster pace. In some cases, over a decade, they've sort of shown double the growth, right? And even in terms of the last 3 years, while this performance has improved a little bit for LIC, and I'm assuming they're showing it because last 3 years has improved a little bit, you will note that somebody like an SBI Life or HDFC Life would still be significantly outperforming an LIC in terms of the premium growth that is sort of evident, right? You can go to the next one. So this is the market share in terms of the total premium collected. So we said 64% here, new business 66%. But remember that this is contingent on a large part of this coming from group. So it is not as profitable as what the other companies might be collecting it at. And the second thing that we need to understand is a large part of this is actually single premium. So पहले साल में सब collect कर लेते हैं. So if you actually look at an APE basis, that annual premium equivalent basis, I think the market share of LIC would be somewhere in the range of 40-45%, not more than that, right? And that's been declining as well. So on an annualized premium equivalent basis, the market share has gone down from somewhere in the range of 55 to 60% about 7-8 years back to now close to 40 to 45%. Every month this data is available on APE. So you can calculate on a monthly basis what is the market share they're generating. It gets clouded by the total premium number because single premium बहुत सारा collect होता है, but जहाँ पे भी single premium collect हो रहा है, you are basically getting the money today and you're losing something in the future as well, right? So over a period, you will see that number, in terms of renewal premium going down. Yahan bhi if you see your column 2, which is new business premium, is higher in market share than the renewal premium, because renewal premium is not needed in single premium payment products, right? Wahan pe to aap already pay kar chuke ho sab kuch. So I think that has to be kept in mind when we look at some of these tables that are there. So that's with respect to these first 3 market share things. I think the rest, next part, I think Saurabh can take ahead with respect to the product mix and distribution channels as well, which are there.
These product these line items are extremely important because these are the numbers that get thrown around in your news article. And at the face of it, you feel that it's extremely large as an organization, but when you look at it on a granular basis, you realize that there are challenges with respect to the growth that they are actually clocking, and that's extremely important for a prospective investor. Yeah, Saurabh, do you want to take up the product mix, because this is extremely important. This sort of tells us where and how LIC has been with respect to its competitors, which gives us a very strategic understanding of how to look at this business going forward.
Sure. So a few more things to add. So, again, because we are talking about LIC more from IPO perspective, more from valuation perspective. And whenever you talk of valuation, one is of course the existing business and second is about the growth. So you would like to see where is LIC in terms of areas which is growing. And when you look at growth, you need to look at growth from, product perspective, you need to look at growth from channel perspective and all of that. And if you see, one, LIC is a heavily agent driven model. So if you look at your HDFC and insurance and especially private player, ICICI, Prudential, they are more bank driven model, whereas LIC, 90% plus of the premiums, it comes more through the agent. And if you look at a history of the agent count in last 6-7 years, there is a slight downtrend in that. And LIC doesn't have that kind of, in-house, you can say, bank channel advantage. So that is one part where you see if, that is not working great. If we look in terms of product, I think PAR is somewhere around participating is 60% and non-participating is 40%. And again, if you look at the margins, the VNB margins and all, as I said, for term products, those kind of products, the margins are higher. In fact, the overall VNB margin of LIC, I think it is nowhere close to the HDFCs and ICICIs, and that is why one reason I feel they should not garner that kind of valuation. So if you do the same embed plus VNB margin valuation, it should not garner that kind of valuation. The third thing is which Piyush already highlighted. If you see the new business contribution and all, so the new business contribution wise, they are still lagging the market, and there is a whole, like in the banking, there is a public to private shift happened. In the same way, in life insurance space also, there is a public to private shift happening. So even though LIC is significant right now, still the shift is happening, which is getting reflected in the in the APE and all these new business contribution margins. And one more thing I would like to highlight, so far we have discussed a lot from the liability side. We have not discussed things from the asset side. So, we know that LIC is so big on the asset side. They manage almost, I think, if not wrong, 30% of all the equity which is there. Even in terms of debt, I think it's part insurance on the liability, but it's kind of asset management firm, AMC, if we look how they are managing those assets. So we also need to ensure that they are managing that asset properly, because if they are not able to manage, that can have another set of negative impact. And how they manage gets reflected, what kind of NPS they have created. Second, what is the distribution of the asset side in terms of equity versus debt. What I have seen typically, if you look at ICICI, HDFCs, they will have almost 85 to 15% kind of debt to equity distribution on the asset side. Whereas LIC for, at least for the non-participating side, which is 40% of the premium, they have almost 35% of exposure in equity. So I'm not telling it is good or bad, because they may have a decent track record of managing the money even in equity. I think there was some data where out of 34 quarters in 14 quarters, they have beaten the index. But it could be volatile depending on the nature of market, because if the equity is larger, and of course they have a very big portfolio, you'll see LIC's name everywhere. Like people, many times we make fun of LIC because whether it was a Wakrangi LIC was there, whether it was a DHFL LIC was there. But when you see in terms of overall product, share, it might be very less, but still it tells about the ability to manage the asset and invest in some kind of companies. Also, when we look at the NPA history of LIC, NPA because of money going in debt side, whether it's ILFS or whatever, there have been NPAs, and those NPAs you cannot ignore. I would say it is on the higher side compared to, again, other private players, and those NPAs need to be get written off. So other reason of lower profit margin could be those NPAs. So we should also look at the capability of LIC from the asset management side also, apart from this par non-par. And this non-par is the par side is little opaque because it is participating, but if you look the kind of returns people make, it is, my personal experience has been, it has never been great return. So there is some kind of opaqueness even there. So all these factors, when we mix, combining in terms of the product distribution, in terms of their margin being present in those areas which is on decline, the public to private shift, the NPA and the ability to manage the asset side, the equity exposure, my view is you cannot tag the same kind of valuation which you are tagging to some of the better managed players.
Fair enough. Yeah. You've already sort of we've gone through the distribution channel and how heavy it is in terms of agents. Just a question here: this percentage of individual agents, corporate banks, all of this has been increasing. Do you reckon that this is the way forward? Do you see any? So do you think that LIC will? Pivot is a very wrong word given how large the organization is, but do you think LIC as a next 10-year story would look to build out its non-agent driven distribution channel?
Piyush, you want to take that?
Sure. So see, I think there's a little bit of a challenge there in terms of they may want to, but how do you really do that in the absence of an actual bank that is present? LIC will not go and put up branches for this, right? That wouldn't happen. They do have partnerships with some of the banks, by the way. So they do have a network. It is not that they don't have a network, but their predominant money comes from these agents. I think they will keep playing to their strength. The challenge, however, is that with the advent of technology, and LIC is not present on most of these insurance aggregators which are there, right? So that's the other challenge that they are going to face, that their traditional clientele will sort of keep reducing. And the new age person who's going to take insurance will always probably go to this, either an aggregator or a direct website, and take the plans from there, which have a better sort of collection of plans. If we go back one slide, you'll see that LIC has very little linked policies, right? And in the non-linked between participating, non-participating, term is again very small as a component. It's not, they don't sell too many term plans. They don't sell ULIPs, or very little amount of linked plans are sold. So it's difficult for them to really pivot so easily from the model they have been. I mean, technically their bread and butter for the last so many years, decades, has been these insurance agents, and vice versa as well. I mean, in terms of the insurance agents also doing well because of LIC. But in this environment, either, it will require a lot of willpower to, at the top management level, to be able to pivot to a technology solution. I'm not sure that, they can do it. If they want to do it, that's anyway a possibility. But whether they really want to do it, they will have the willpower to do it, they'll have the focus to do it, I'm not so sure about that. I personally, I don't think it's so easy to pivot to a banking model so easily. I mean, if something changes tomorrow in regulations, they do a good tech investment, then things might change. But I would tend to believe that most of the newer age insurance purchasers, insurance buyers would probably be looking more at some of these term / ULIP kind of products rather than the traditional ones, because the returns have not been that great either.
Rob, you want to add anything? The next, yeah. So taking forward what you guys are saying, I mean, in terms of productivity, LIC is by far the winner in this particular scenario. Saurabh, do you want to spend some time?
But that has a reason, Ronak. If you see the history of LIC, it has a much longer history, which means LIC agents that did have much longer time to build a longer customer base and all. So there could be other reasons why the productivity could be higher compared to SBI or HDFC, which is relatively newer in terms of their agent expansion capacity.
Yes. Yes. Yeah, this is a 40-year story that we're talking about at the end of the day. So of course it's going to make a very big difference. Okay.
And one more point, Ronak, I would like to stress upon, because we told that LIC is only in par and non-par with 60-40. But if you look at HDFC or if you look at ICICI, they have a much better uniformly distributed product mix. And when negative circumstances comes, your diversification comes to your rescue. So that also I see as a risk, and non-par, as I highlighted, it carries balance sheet risk if things go other way. So we really need to see in their non-par, which is 40% share, what is the kind of commitments they have made? Are they aggressive commitments or conservative commitments? Because it's a significant part of their book.
So this has been sort of a detailed look at LIC's business from a product as well as from a distribution perspective. We've sort of looked at how LIC pegs itself against its competitors in terms of new business premium, as well as from and how the split is between group and individual. This is sort of a summary slide in terms of what are the different points that we've spoken about. I can go through it one by one. High exposure and equity share and equity exposure, something sort of stressed upon. NPS are significant and cannot be ignored. There was this one conversation that we were having, which is anecdotal in nature, where we went through LIC housing finance, and we realized that they don't, for the longest time, did not release their gross NPA numbers, even though they are a listed player. So that sort of is anecdotal in nature, but can give you an understanding of what we are dealing with in terms of numbers. Lacking diversification, yes, of course, the product portfolio has been geared towards one plan and has been that way for such a long period of time, which is why when one does question whether going forward the company will change, your first thought is to sort of assume that it would not. And which is what I think Piyush also alluded to in terms of not just from a distribution perspective, but as well as from a product perspective. How much will the company change going forward versus how the industry is performing is something that cannot be ignored at all. Because ultimately, once you do become a listed player, once you do become investable by the retail population, then you start getting compared at a valuation level to your competition. Until you're private, of course, these things don't matter because you have a different agenda. But once you do become a listed player, once you have a public shareholding, you are then judged in comparison to how your peers are performing. And when we look at LIC,
Ronak?
Yeah.
Yeah, one more point to add, because you told about private versus now becoming a listed company. So till LIC was private, government had 100% stake and they could have taken their own decision. So, whenever market falls, government tells go and buy. If IDBI crisis happen, government tells go and buy IDBI bank. I don't know if in future they can do with, the same way they can continue it, because they have a responsibility to shareholders, but that is another risk which we should consider. Second, I have seen in LIC DHRP, if you see, there have been multiple instances of employees going on strike and all. Usually, I don't hear about labor union issues in private sector insurance companies. I don't know again how in future it will pan out, but I'm just highlighting, considering these things which are there, they have their own set of risks. In future, it may be very different because it's a listed company, but we should not ignore it.
We should definitely not ignore it, and it's a very big point when you go from private to public. So it's something that has to be considered through and through. And of course, the other points are something that we have sort of touched upon. The next slide is extremely important because I think Piyush, I would request you to spend some time on this one to sort of give a little bit of a perspective on the valuation for current companies, because there was one question why HDFC has performed poorly, and the numbers actually do suggest so. The data is a little dated, but you get the perspective.
Sure. So I think, to be honest, all of them have performed poorly in the last few months. And my initial sense, there was a question around that as well as to why the stock prices have fallen for insurance players. My sense there is more to do with the markets in general, that, anything that was being paid a significant premium because it was, quote unquote quality. I think that extra valuation premium that was being given has been settled for a lot of the names. It's not just insurance. I think we can look at other sectors as well. I mean, banks, you could look at, some of the other sort of well-named quality stocks in India as well. And I think insurance sector in general, the top few names are no exception to that rule. Coming back to this slide, if you see some of the terms that are there, this is from one of the broker reports, I think, if I'm not wrong. And you will see some of those terms that are mentioned there. In terms of market cap, you have price to embedded value kind of a calculation, which is you take the market cap and divide by the embedded value. So you get some sort of a multiple there. You can get price to embedded value forward, which is, what do you expect the embedded value to be in FY22 and FY23, and you divide the current market cap by that, right? That will depend on what kind of growth you are sort of assuming the embedded value is going to generate. But you could take any one of those columns. Let's say you take the P by EV 12-month trailing, and you look at the current column there. You'll see that HDFC Life gets a slightly higher valuation than ICICI Max or SBI Life, right? Now, there is again a reasoning behind that. SBI Life, I think, is predominantly, or 60% of their policies are ULIP, so margins are lower in that context, and so strictly not necessarily comparable with HDFC Life. I mean, you can compare, but you have to assign that slight bit of premium or undervaluation on account of these changes that happen. The second part is with respect to the other sort of channels that exist with somebody like an HDFC, which is because there's a banking history to that, and the fact that HDFC as a franchise has done very well across banking, housing finance. They've done sort of wonders in the last 15-20 years. Leave us out the last 6 months or so. So I think the market generally tends to give a premium to known executors of somebody who's done well in execution. You will find a premium being ascribed there. But all in all, there are two methods broadly that you can look at. Is one, you take the market cap and divide by the embedded value and just straight away put a multiple saying, "Acha, this is what you've done historically and this is what you're going to do in future." This is, in a sense, some sort of a variant of the price to book value mechanism that you do for other sectors. Not exactly, but some variant of that. The other method is what I think me and Saurabh were saying earlier, was with respect to ki acha aap embedded value ko alag nikal dijiye, because this is history, you know about it, it's there on the books and you can check it out. And add to that the value you're going to generate in the future. So then you segregate it into value as of now and value that you will generate in the future. That value that you can generate in the future can be added separately by taking the value of new business or uspe ek multiple, put a multiple on that, which could be, as Saurabh was saying, between 10 to 30. Depending across geographies, across companies, depending on their growth rates, what kind of products they're selling, it'll range between 10 to 30. If you do that calculation, as Saurabh was saying, for ICICI Prudential Life, market cap is 60,000 crore, EV is 30,000 crore. So the difference left is about 30,000 odd crore. Value of new business is about 16 to 1800 crore. So आप divide करोगे तो you'll get about, close to, at this point of time, they would be trading at somewhere about 15 to 20 times, 15 to 17 times value of new business in addition to EV. Right, that's sort of the average-ish range. Some of the others might be slightly higher. If you think about SBI, I think SBI will probably be slightly higher in that same vein of calculation. If you try and do, you'll probably get SBI closer to about 20 to 25 times of value of new business plus embedded value. And उसका भी शायद एक reason है, अगर आप थोड़ा सा पीछे किसी slide पे, if you go and look at the growth rates of these companies, ICICI Pru Life has not grown as fast as some of the other guys in terms of their premiums, and that's probably why they get a slightly lower valuation as compared to some of these others. Can we definitely say all of them are sort of great investments? Not so sure, to be honest. This is a slightly tricky industry, so you do want to get things in your favor before you want to kind of invest, just like banking, right? The other issue with most of these sort of finance sector companies, banks, non-banks, other financial companies, is unlike other sectors, these companies run systemic risks, right? Which is something you should be very careful with. Agar Jet Airways band ho jata hai, to SpiceJet and Indigo benefit from it, right? But in financial services, you will never hear that one bank closes and other banks benefit from it. There's generally panic all around, right? So if something goes wrong for one financial services company, one NBFC, others will follow suit. They're all interlinked, and usually these are systemic reasons why things go wrong. So if there's an interest rate issue that is causing a challenge for one life insurance company, it's going to change that for other life insurance companies as well, right? Varied degree of challenges could come. You might have a lesser impact as compared to somebody else, but impact hoga. So I think you have to be mindful of some of that as you look at it. I think that's the context here. There are some other data points that are given, like what is VNB margin, what is APE growth, annualized premium equivalent growth. Isme FY21 you can ignore because this is the pandemic year, so things got a little bit awry in that context, and especially I think somebody like LIC might have faced a little bit of bigger challenge when everything was just shut down. They don't have a big online presence in that context. But I think 22 onwards things will normalize again, so you will see those things kind of playing out. Saurabh, if you would like to add anything to this.
Yeah. So the way I take it is there is a quantitative way of doing valuation, which is more academic, all this embedded value and all. And second, there is a behavioral way of doing valuation. And when I say behavioral way, it is like when you see everybody gung ho, you don't invest in that sector company. When you see that people have given up, oh my God, paisa nahi bana, 5 saal ho gaye, this is the worst sector. That is the right valuation. And there is no formula, there is no book. So let me tell you, when first I look at life insurance industry, that was in 2018. उस समय HDFC का IPO आने वाला था, and I was very much active in this value picker group, and उनका एक value picker चिंतन बैठक होता है, 20 people, they sit in Goa, actually right now in Goa on vacation. So this is where I also did this research and we presented. And we had we always invited some of the big, fund managers, and one person I will not name, I don't know I should name, but I respect him a lot, manages almost 4,000 crore plus. And he was also there in the presentation, 3 of us, we all presented. And he was also like on the same foot that, look, this is a very complicated industry. So I shouldn't say just for the sake of it. And if you look at that time, 4 years back, everybody was like, HDFC group mein to paisa banta hi banta hai, just blindly keep doing SIP. That is a term. So HDFC Bank, HDFC, and there are the stats which I tweeted few months back. Actually, I made that tweet in 2020. If you look at the count of, I take retail as a measurement of euphoria, how many unique retail shareholder count gets added in a stock. If you look at that data for HDFC Bank between 2014 to 2019 March, 5% of CAGR growth you had in the retail shareholding count. But the moment the small cap crisis happened in 2018, everybody was like, hide in large cap, hide in quality. That is what will make money. And those who shifted there, if you look at the HDFC Bank retail shareholding count from 2019 March to 2020 March, there was a 29% increase. So from 5% to 29%, 6% increase. Nothing wrong with HDFC Bank. I believe even for 1 to 3 years, money making is all about circulating. When big guys, they get out, prices fall, all of that happen. So that has not done well. And you pick all the insurance companies, it's not like they have not made money. Those who could get at the IPO price or those who could buy at bottom, still they have made 15% CAGR, and these are compounders. You can't expect a CAGR 20 bagger out of it. These are well-discovered companies by institutions. So still people have made 15% return, but buying at obnoxious prices, that will not create money. So I feel now slowly the euphoria is reducing. Even now when you see HDFC Life on the same valuation, EV plus VNB multiple, I think it trades somewhere around 35%, 35 times VNB multiple plus EV, which may not be so cheap, but yeah, it is coming. For me, it is coming in that range, that 10 to 30 range, which I said, of course, I will never tag 10. For me, for HDFC, the range might be 20 times. So I think when academically it's too difficult to evaluate, you have to look behaviorally, and then if you believe in the quality of the management, quality of the company, you should I mean, I'm not a registered investment advisor, but that is what I practice and follow. So there are companies like ICICI, HDFC, which now I am tracking from a valuation perspective. 4 months back or 6 months back, we had done a webinar on insurance industry. That time also the stance was same. And that time these companies, they were making almost lifetime highs. But I think now slowly things are cooling off. The other thing is, if we see now interest rate, we are almost at the lower end of interest rate cycle. And given a lot of these assets, because these are industries which work on the float, a lot of these companies have investments 80% in debt products. So if the interest rate cycle reverses, it goes up, you can see a shoot up in the rise in the profit also. So that can also help to the valuation. So I'm not discarding the positive aspects, but I am not discarding that euphoria it had. I think these are times, I believe this is a time when we should start studying life insurance companies. If little bit of more fall, we can make decent money, but that is on the companies which are growing and which much better diversified book and all the things.
Sure.
Yep. I just love the fact that you spoke about a behavioral perspective. So yeah, that adds a lot of context, especially given where we're coming from over the last 2 years to where we're heading to now, and especially with global geopolitical issues as well. One extremely important aspect to consider, apart from valuation, is given the size of LIC and given the market cap that the government initially will sell, the valuation that it comes at, the percentage that they offload, and accordingly the free float and the normal market cap, what are possibilities in terms of the inclusion in an index? And I'll let you sort of run through these calculations because regardless of whether you value the business or you look at the valuation or you look at the business on its own, there is a particular amount of interest that we should assign to percentage weights. And if a company is part of the headline index, then automatically there is a particular responsibility that we add to that. So, and LIC, given the market cap, given its free float market cap that might arrive, has that kind of scale. So Piyush, you want to just go through this because this is equally important in comparison to sort of looking at a company from a business and from a valuation perspective.
Correct. So now one of the key elements of why this IPO is so hyped and, why people are looking at it is because a lot of institutions are looking at this as an investment, framework. And the very fact that this is going to be, assuming the valuation, the initial sense of what the government wanted was about 12 lakh crore kind of a thing. Even if it is slightly lower at 10 lakh crore, India has two companies that are more than 10 lakh crore at this point of time of market cap. So even assuming that it is slightly lower than 10 lakh, this is the third largest company in India by pure market cap that is available, right? And free float is how Nifty is sort of constructed, because you remove the promoter shareholding and you put the free float and weight it based on that. So they are coming with a 5% offloading at this point of time. They are supposed to kind of in the next 2-3 years offload more such that the free float increases. There, I think things would be easier because then they will automatically kind of go into the index. But at this point of time, the last company, as we were discussing in Nifty, is IOC in terms of weightage. And their free float market cap is about 50,000 crore. So give or take a little bit, if assuming the valuation is 10 lakh crore, I think there is a fair chance that this comes right away into some of the indices. And there's a separate rule for coming into indices for such large companies when they get listed. So I think on the 10th day, you look at what is the market cap, and based on the first 10 days, you kind of take a call on that. Unlike some of the other smaller companies where you have to have a certain history in terms of how much time you have traded and all of that. It's probably going to get into the MSCI index right away because there the caps are slightly different, and those things are there. The reason this is important is because that is where a lot of flows will happen from the passive index fund investors, right? All the ETFs and all the index investors will suddenly jump into, they will have to buy this because LIC is going to be a part of the index, and you have to realign all of those things over a period of time. Some of the people might want to get in early just to take an advantage of that situation at a later point कि अच्छा अभी हमें कम price पे मिल रहा है, बाद में शायद ज़्यादा पे खरीदना पड़ेगा. So in that context, I think people might look to move towards that in the anticipation, even active funds might choose to kind of take it that when it does get into the index, we will automatically have this in our books. So that's the construct. We're not entirely sure at this point of time. Also, I think there's this news that's now coming that it could get delayed given what's the market condition at this point of time. I think where it lists is going to be important, but if it is going to be around 10 lakh crore of market cap, then I think there's a fair chance that we'll see it pretty early into the indices. May not be immediate in terms of Nifty and Sensex, but I think there are news pieces that are going around that are saying that it should be a part of the index pretty soon. When it does become a part of the index, then of course, it then automatically becomes a part of all the passive funds that come in. So from
just to add to that, the rule is the 10% dilution in the first 2 years, 25% dilution by the first 5 years.
Correct.
What that means is that there is a constant supply of this large company that is there.
That has to come in.
So that on its own.
Yeah. So I mean, this is huge as an IPO. I mean, this is not a chotu 5,000, 10,000 crore of an IPO that is, and even those are not small by this thing. We are now just saying by comparison. But Paytm was what, 18,000 crore, and usse pehle tak I think the largest was 10-12,000 crore. So 5,000 crore is not a small IPO in India as per historical standards, but after this one, 5,000 will become small because this is now going to be 50,000 kind of a number. How good the market conditions are, anybody's guess, to be honest. We'll see. I think LIC should still find takers in the institutional space.
Because my assumption is if the finance minister has come out and questioned whether we should go through, that gives us an indication of what to expect in terms of if it is in this financial year, or because the disinvestment target is primarily dependent on LIC's IPO going through. So,
I sense that it's not going to come in this month. But that's purely my personal opinion. I could be wrong on that. I think it's a sort of a, bullet point kind of a thing for the government as well, that we did LIC IPO. You don't want it to go wrong, right? I mean, if it goes wrong, there's a lot of embarrassment in that context, I think. So you will play safe in the context of where the market situation is. And to be honest, I think it's a fair call because it's not an internal issue. Now it's a global issue. All markets are under pressure at this point of time. Right?
You can't, like, internally, I mean, I could imagine these guys pushing it through and telling every fund manager on the street, look at the market cap, look at the index weight, you don't have a choice, you've got to subscribe to this. Correct. But like now that logic particularly doesn't hold because in general, globally, you can't control scenarios.
And the volatility is abnormal in the last 2 weeks, right? I mean, you just don't know what will happen on one fine day and, randomly what markets will react. And us samay, if the IPO is open, there could be an adverse impact on that day, right? Too much of uncertainty in the very short run.
So, Saurabh, any final thoughts? Because this is the last slide. We can open it up to questions after this. I feel like we've had a very, fruitful discussion, top to bottom, gone bottom up, gone top down.
Yeah, I think you have covered everything. Let's open it up for questions.
Yeah.
Okay, cool. So, firstly, thank you so much for the participants that stayed through till the end. Because it is a relatively complicated sector, even though we've tried our level best to sort of dumb it down. We've done top to bottom in terms of industry, then we've looked at LIC, we've looked at players, how they pan against LIC, and we've looked at valuations, as well as including LIC in an index. Anybody, any questions? And then we're all open for questions now.
I think there are a few questions that are there. I'll pick up one from the chat box that I see from Gautam, which is, has the balance between LIC and other insurers market share been achieved, or is it going to decline even in future? Saurabh, what do you think? LIC market share lose karta rahega?
So, yeah, I mean, nobody knows the future. Nobody knows the future, but we go with previous trends, and the trends say they are declining, and that is how it should go until LIC does something which they have never done in the last 5-10 years.
I would also second that. If you are sitting at a 70% market share, it is very difficult to grow from there. And given the history that we have seen at this point of time, there is no evidence of saying that they're going to turn it around. It's probably going to be a slow.
The only thing, Piyush, I can think of, let's say a regulator comes with some kind of decision like, banks can't sell insurance policies of their own.
Correct.
Something which hampers the private sector insurance growth. That could be one way, which may be more regulator driven than internally LIC driven. That is the only kind of scenarios I can think of.
Sure. Sujay, I think, has a couple of questions on the Q&A panel, which is what about the impact of stock market returns on EV of LIC, since it has about 29% in equity. See, I think till the time you're private, nobody cares. Now that you're public, you will be in public scrutiny all the time. So I think that will have an impact if the markets are not doing well. All the sort of stunts that they have been doing, as Saurabh was saying in the past, कि IDBI जा रहा है तो उसको खरीद लो, and market आज गिर रहा है तो उसको खरीद लो, ONGC का follow-on offer is not getting subscribed, so उसको खरीद लो. They've done this in the past, and I think I maintain that if a promoter is basically doing this, you should probably be careful about this kind of a promoter. It's just that the government, so they get away with this thing. But I think just to give an answer about that, my sense is once you are listed, you do have to be careful and mindful of what's happening in stock markets. And I think IRCTC gave that flavor one fine day, I think a few months back, जब उन्होंने बोला कि service revenue में 50% we will keep, and the stock tanked 40%, they had to come back and say कि अच्छा, we will not do this. Once you get listed, I think some of these things, in fact, one of the whole process of or reason why a lot of the companies tend to list themselves is that corporate governance improves, because now you are in scrutiny all the time, right? So I sense that itna easy nahi hoga after this to take those decisions that you had been taking in the past, which has its pluses and minuses, as you see. My sense is, given that so much is in equity, there could be a little bit of stress if markets fall, significantly. There is then that double whammy that plays out.
Pranav, Sampath has a question. Amit, can you give him?
Yeah, there is one more question on the COVID impact. So yes, the COVID impact has been there both on health insurance companies as well as life insurance. In fact, if you would have tracked Star Health IPO, I think this was in last 5-6 years, this was the first year when they made losses. And Icici Lombard, it got saved because it's a much diversified book compared to only being a pure play health. But yeah, these are odd years, assuming we don't see COVID every second, third year. These are odd years. But yeah, there has been an impact in terms of the claims and hence profitability. Go ahead, Pranav. Please ask.
You're on mute. Just unmute.
Sure. Can you hear me now?
Yes.
Yeah.
So what I was asking is, see, as we know that all of the insurance sector is taken care by Swiss Re. So now, since there is a war situation at this moment, so definitely the IPO, I think, will be postponed, right? Probably 2-3 months or probably next financial year. So, how exactly, as in LIC as definitely it's good as far as, but aggressiveness is concerned, it is not as aggressive as the other players. So I just want to ask one thing, how exactly, as in the Swiss Re and everything will be affected due to this in the war situation, as you know that the situation between the Ukraine and Russia, which is going on right now.
I think you mean Swiss reinsurance? Yeah,
the reinsurance thing. Yeah, it's a bigger picture than the insurance. Like जो भी insurance होता है वो Swiss Re से reinsurance होता है.
I believe only part of the book they go for reinsurance.
Correct.
And what part of the book goes for reinsurance, that will again differ player to player. And frankly, I have not done a lot of detailed work.
Mm-hmm. Because Swiss Re is something which every insurance player, it's taken not only for LIC but for all the players of the world, like the reinsurance thing.
Yeah, so your question is more around LIC because I heard broken statements. Can you repeat the final question? Like one, I heard that how it will act in Ukraine war, but what is the context? Whom?
No. So what I was asking is, as in, see, LIC as it's definitely not as aggressive as the others, and definitely
again,
when we take insurance,
maybe
there is a.
Are you able to hear?
I can hear. I'll repeat once he says.
Okay.
LIC is saying is not very aggressive as compared to some of the other guys. Go ahead, Pranav. Pranav?
I think what his question is, if I've understood it correctly, is insurance players are reinsured primarily by Swiss reinsurance.
Correct.
Now, there is a war-like situation in Ukraine. There is a conflict in Ukraine with Russia, right? So, I'm assuming European nations in general are going to get impacted.
Okay.
So what his question is that how does LIC get impacted because of the reinsurance of by Swiss Re, percentage of which we will have to see, because there are multiple reinsurance players globally and locally as well. And
Absolutely.
and how does that sort of impact LIC right now in the short term and the long term? Is that your question, Pranav?
Yes, you're right. Also, one more thing, see, LIC is basically all over world. So like people, like education people, there are few people in Ukraine. Definitely, yes, we are getting them back. But, if someone is lost their own ones in that missile or something, so, definitely as an insurance provider, as in Swiss Re, definitely it will be impacted there as well. So that's about what my question here. Thanks for understanding.
Thanks, Pranav. I have not done much work in this. So my knowledge is a little limited.
So my sense is one part of this is already priced in the product. They have this sense of what happens if you go wrong a little bit on your assumptions here or there. Of course, if you go, I think Corona was one of those things that came in suddenly, and they nobody had put that into perspective. And now I think insurance premiums globally have gone up because they've started pricing in this. In fact, I was reading somewhere that in the US, the insurance industry is giving data that there is an increase in mortality in the 25 to 50 year age group, and so consequently premiums will kind of change, and that will go up. Wars you can't plan for it, but I think a part of it, at least the reinsurance guys keep it sort of covered. Will the war directly impact somebody like a Swiss Re? Unlikely, because they're like too large. In that context, will the war directly sort of impact somebody in India? I don't think the number is too large, honestly, to sort of impact any Indian insurance firm. I mean, we're talking about 6,000-7,000 people from India, and we hope all of them come out without any kind of a risk. But even otherwise, I don't think there is. As callous as it might sound, insurance companies work on the law of large numbers, right? You are basically premising the whole idea on millions of people and a certain amount of risk materializing in that. In that context, I think a few more here or there does not really alter the things unless this becomes sort of a precedent going on and on. I mean, if the war escalates, then we start taking note of it. I think the base case at this point of time is this won't escalate. That's my understanding, but
thanks for clarifying it, Piyush.
Sure.
Thanks.
Sure.
Just to add one more thing. So 2 months back, I think I was doing research on this insurance webinar. So Swiss, they are one of the reinsurers. They have a very good PDF where they have covered 200 years of history of insurance, and they have covered all these phenomena in war and all, and how it impacted. So of course, depending on the the nature and the extent and how many countries covered, there were losses. And that is where some of the countries from 90s, some of the companies from 90s, they start diversifying across countries. The other thing is there is a war terrorism fund also, where all the insurance companies, they have to pool in money. I don't know when and where it gets used, but given there is a context of war and terrorism, there could be a purpose where this corpus might be used from the insurance purpose. So you might like to research more on that specific corpus for that war and terrorism.
Correct.
There is, I think, Pranav, I think there is another question that is from Mr. Arun Biswas. I'll read it verbatim. If rural/suburban India's mentality change and they start investing only in term plan instead of LIC, term plan of LIC instead of any other money back, more profitable life insurance policy, will it start impacting LIC profit margin? Any thought around this area?
Term plans are very profitable.
Yeah.
Right, so they would actually love it. That's my understanding, at least. But I don't think aisa hoga. Matlab, when insurance companies have to come and tell you that sir utha ke jiyo and kya aap ek zimmedar pita hai and all of that, it's clearly a push product. People are not going to buy it on their own, and term plan unfortunately suffers with that caveat as well, that you are
Rural India is purely a push area.
It's correct.
Heavily pushed in the sense कि अगर आप एक agent है, which is why the agent channel has been so successful for LIC also. because lack of education is so high in tier 2, tier 3, I mean beyond, that ultimately aapko push karke, and then you're pushing products and you don't know which other products are available.
Correct.
In that sense, that is the scenario. I think we've gone through most of them. I mean, there are some questions, but I feel like we've answered them through the session. Any other questions from anybody else?
In case LIC or any other insurance company goes bankrupt, what will happen? Very hypothetical question. I don't know. I'm sure there would be provisions around that in terms of how much the reinsurance clause is generally for that, right? So that if something goes wrong at the insurance company level, there's a reinsurance of that is available. Historically, I think, again, law of large numbers, they usually, unless something goes catastrophically wrong, it won't change things.
To the extent that you can't. I mean, even Star Health, for whatever it's worth, was able to sort of, I mean, I know much smaller in scale and sort of much more detail, but like they were also very well prepared and are actually getting out of it going forward also. I think there's a question. Amit, can you pass the mic?
Yeah, I think some people have asked about should you subscribe for the IPO. So I don't think we can advise directly here. There's a question, would I subscribe to the IPO? I don't think so.
I don't know. I think between the three of us, none of us are probably going to subscribe to the IPO.
But we're not advisors, so we would recommend that you do talk to your advisors before taking that decision.
And just on the return part, so again, learning from the history. So when I was researching, I tried to look for European companies, especially life insurance companies, which have beaten the market. So what I saw, the average return of the insurance industry, it has not been super exciting. It has not been bad. It is somewhere near to the same compounding, except one company, Prudential, which was a winner. And one more thing is there that some of these companies suffered from events which the world saw in last 20, 30 years. And now the industry is little much better prepared. So when you say, the whole company can go bankrupt, my answer is it's not so easy like it happened in the past, because there is a learning. The Indian regulator is much more conservative in nature when you look at how they regulate, and that is good from Indian perspective. So, and for valuation and LIC, my stand is also, I mean, I have better private companies to look at. So the first question is, do you to invest in a number one, number two company, or you want to go for something which is laggard right now, just because of even if you get valuation attractiveness. Some people, they will just wait for the number one, number two. I belong to that category. So I better wait for those.
So I can't hear you. Piyush, have you?
I also can't hear Saurabh. I think he lost his voice in between.
I think those are the questions that we have. I think those are the questions that we have. Can give it a couple more minutes, I guess. But yeah. So I think it's been a great session, guys. We've had a pretty good audience from start to end in terms of how we started for what could be a pretty, not boring, but we try to make it a little interesting. And yeah, I think you have a lot of information on how to sort of look at insurance companies, how to sort of look at LIC, what are the larger factors in play, how to track these companies, and hopefully also find yourself a good policy. I guess that's something that we've also covered here.
Sure.
I think Saurabh has dropped, but thanks to him. Thank you very much to Saurabh for coming through. Thanks a lot, Piyush, for coming in. I think we did a fair bit of work also on this, including getting a teach-in on the sector. So
yes,
I think hopefully we had a good session. Thank you very much to all the attendants for coming in.
Thanks, guys. Thanks a lot. You can always connect with all of us on Twitter. I think we're all there on Twitter and LinkedIn. So you can find us there, and would love to be in touch. Thanks, Ronak, for this this organization. This was quite good, and was a pleasure to be here with Saurabh and you.
Okay, cool. Thank you so much. Bye-bye.
Thanks. Bye-bye.